Hello, everyone. As people are joining in, I'm just going to say that we're going to give everyone a minute or two to get in here before we start with the presentation. I'm going to just share this so people know what they are watching. But yeah, like I said, we're going to give everyone a minute and then we'll get started here. Alrighty, I'm just going to get started with a quick little intro and disclosure as people kind of flood in and yeah, just get us started here. So today we've got building passive income through qualified accounts in this current real estate market, brought to us by Jason Engelman. But before we get started, I do have a quick disclosure I have to read. The views expressed by speakers at the CAMA webinars are those of the speakers only and may not reflect those of CAMA, its members, or employees. CAMA Plan does not guarantee the accuracy of information provided by the speakers or attendees. Professional advisors should be consulted before implementing any options presented. CAMA Plan absolutely does not endorse or recommend any individual or organization, including the speakers. CAMA Plan, its members, and employees do not accept liability for losses and/or damages arising from errors or omissions within, reliance upon, or any use of the information provided by the speakers. Individuals are strongly encouraged by CAMA Plan to conduct their own due diligence before making any investment choices. CAMA Plan does not act as nor offer the services of an investment advisor, CPA, realtor, or attorney. If tax, legal, accounting, investment, or other similar expert assistance is required, the services of a competent professional should be sought. And now on screen, you'll see the contact information for one of our client executives, William Mucker. If you have any questions following this regarding self-directed IRAs or 401ks or opening an account with CAMA Plan, feel free to give him a call, shoot him an email, and he should get back to you very soon. With that, I am going to turn it over to Jason and allow him to begin his prepared presentation. And my green screen fell, so that is great timing. Jason, please take it away.
Hey, Michael, thank you so much for allowing me to be a part of this. And CAMA Plan has been a great friend and partner of ours. Carl is a good friend and just a really good man. And got a great story with him. I know he's shared it a few times, and I always like to share it because I guess it keeps me humble. But went down and visited him and his son Richard a couple of years back, and we went fishing. And I was maybe a little cocky in the sense I didn't take Dramamine like I probably should have. And I think there was a hurricane that was coming, so the waters were really, really rough. And we had a good time, caught fish, but man, I got sicker than a dog. And we were talking, and I would stop and have to throw up and then start talking again. And anyways, funny story for sure. Definitely humbling, but great time. And I do appreciate the fishers and their friendship, and they're great people. So thank you so much for allowing me to be part of this. I'm going to share my screen, and so that way we can pull up the slideshow. I'm going to be talking about building passive income through qualified accounts in this current real estate market. And the word current is very, very important because the real estate market has really shifted this year. And we'll cover that and explain kind of the approach that we're taking and we're recommending investors taking, and kind of explain just a little bit of a different mindset. It may be somewhat similar to things you've heard in the past from other speakers, or maybe you've been to a conference or a different place where you hear different real estate speakers. And so it may not be like this brand new idea, but it's just a different mindset to really take advantage of money sitting in your qualified accounts. and that I think a lot of people will sometimes miss or they don't utilize. And so we'll talk about that. I'm super excited about this topic and kind of what we are doing and what we're seeing for our investors right now, but also just to be able to share what we're seeing in the market, because again, it's been a very interesting year to say the least. And I'll dive into that a little bit more. So building passive income through qualified accounts in this current real estate market. Just a little bit about me. Again, my name is Jason Engelman. I'm the founder and CEO of Freaky Fast Capital Group, also known as Freaky Fast Home Buyers and Investments, and grew up in a pastor's home. And so that was definitely interesting. I'm a PK. If any of you are familiar with PKs, we were told that either A, we were the funnest people to hang out with, or to watch out for us. That's not always the case, but yeah. So I grew up in a pastor's home and really thankful for my upbringing. My beautiful wife Tori is the blonde standing next to me. She's a country artist. And really, really proud of her. She's got a lot of great music out right now on Apple Music and Spotify, and doing a really good job. And so I'm always really, really proud of her and what she's done. We're from Fort Worth, Texas, and we started our real estate business. It got involved in real estate in 2017, and then started Freaky Fast in 2019. And then if you notice, I'm a huge Buckeyes fan. Disappointed with this year. I was hoping we'd make the playoffs, and that didn't happen. But anyways, always a Buckeye. Just a little bit about Freaky Fast. We founded the company, like I said just a second ago, in 2019. And our primary focus was turnkey rentals, and it still is. We would buy distressed properties, rehab them, get them cash flowing, and then our in-house property management company would manage those properties, and we would sell them to individual investors. And so we built the company doing that, and then we started adding other opportunities to invest, like funds and all other opportunities like land development deals and so forth. We've purchased over 35 million in assets in the last 4.5 years, and in 6 states. Ohio, in Georgia, Indiana, Kentucky, Texas have been our biggest states that we've been acquiring in, and looking at purchasing properties in Mississippi and Alabama and some other states currently. So a lot of great things on the horizon. And then our track record for our funds and investments is between 9 and 15%, just depending on what strategy you invest in. So I am proud of that. Let's talk about the real estate market trend. I think that's what everyone's interested in. It's been a very dicey year. Depending on who you listen to, you get different information. It's very like static out there. If you maybe watch the news, or you read an article, or maybe you see like some ad on Facebook, or maybe a webinar, you go to an event, there's a lot of conflicting news out there. I'll be very transparent and candid with you. This has been the probably hardest year of my life in business. It has really tested my patience. My faith has definitely been tested. Like, what's going on, God? I had a full afro when I started the year, and as you can see, I'm losing it quite aggressively. And I joke in some ways, and in some cases, it's been a very challenging year, and I'll dive into that just a little bit more, and kind of explain some things that we're doing, like calling audibles, Peyton Manning, Omaha at the line of scrimmage, just to because of what the current market is doing, and then how we can be successful and our investors be successful. What's interesting is the market has stayed fairly strong when it comes to one thing, and that is pricing. You've seen pricing maybe drop just a little bit in different quarters this year, but then you've seen it bounce up. But overall, the real estate market in general has stayed really strong with these type of data points. And so just to mention a couple of them to you, I thought it was very interesting. This is the highest in all time history of America, valuation of $47 trillion in real estate. Another very interesting fact, the majority of homeowners currently have rates under 6%. I was reading somewhere else, I believe it was the Wall Street Journal, 9 out of 10 homeowners have interest rates less than 5%. And that has put somewhat of a strain on the market, and it's kept prices fairly stable. because people who maybe are interested in selling, but they've got a house at 3% interest, they don't necessarily want to sell that right now and then have to go find another property that's going to be at 7% or 8%. And so that's kept the inventory on the market very low. And so that's what's been very, very, very interesting. And so that's one data point that we've noticed is there's just not as many people, homeowners, that are selling properties because of the interest rates that they currently have. Also, unemployment's remained fairly low, and it's bringing new home buyers into markets looking for properties. So these few data points here is one reason why we have, to the chagrin of a lot of economic or advisors and experts, to their chagrin, it's remained fairly strong. We haven't seen like this huge nosedive in correction, but we have seen some different things that have happened in the market that have created problems, and I'll cover that here in a minute. Some of the hottest real estate markets right now are in the Midwest. Ohio and Indiana, several markets in those states are on top of the real estate market charts of what have been the best markets to buy or sell. And one of the reasons for that is the cost of living there is still very, very reasonable. There's a lot of job growth in the Midwest. Unemployment is extremely low. And you're seeing a lot of millennials moving maybe from the West Coast back to the Midwest. You know, their parents moved from the Midwest to the West Coast or down south to get out of the weather. My family being one of those. But now you're seeing a lot of my generation moving back just because it is a great place to raise a family. It is a great place for getting a good job, and then the cost of living is still very reasonable. And so you're seeing those markets, even Wisconsin, Nebraska, states that you wouldn't necessarily think would be great investing states, really starting to create opportunities for great investments and cash flow. Inventory is down, prices are stable. So I kind of covered that just a little bit on the 2 slides. And I'm just kind of breezing through some of this, and then I'll kind of explain where I think the market's going and how you should capitalize on that. What's interesting to me is, again, prices have remained very, very stable. And again, part of that is the fact that a lot of homeowners aren't wanting to sell because they're locked in at interest rates. The other reason is inventory is down because 2009, 2010, new construction came to a complete halt. So we created this huge deficit of demand for, or a supply for the demand that's coming. In the United States, we're seeing the largest migration in the history of our country because of the millennial generation, whether they're moving out of their parents' basement, whether they're moving out of the apartment that they were sharing with 4 or 5 roommates. COVID had a lot to do with that. You know, people being quarantined in smaller spaces. Now they want to get out and buy and have a bigger space to live in case if that ever happens again, or they're starting families and now they're ready to move into the single family sector. So we're seeing this large migration. Problem is we just don't have enough inventory because of new construction deficits from 2009, 2010, and even a little bit in 2020 when supply chains really took a hit. You mix that in with the fact that a lot of people are sitting tight on the properties because of low interest rates, and that's putting a real strain on the market for inventory. So as you see, there's a lot of properties that there's not as many opportunities to buy, but it's for the demand. And so a lot of people are kind of waiting to see, you know, interest rates drop, and there's some good indicators that's going to happen next year. So that has created prices to remain fairly stable. And also what you're seeing, because there's not a lot of properties to buy, rental prices are continuing to rise. And so rental properties right now is a great strategy to invest in. You're seeing cases where homes were rented for $1,200-$1,300, and that's usually the average, is jumping to $1,500-$1,600 in a lot of these markets. And they're being paid by good quality families, families that want to buy a home, but maybe aren't able to find one, or interest rates have caused them to have to wait a little bit and put them in a holding pattern. And so they have moved into the single family sector. So it's really a strong investment strategy right now. Um, Again, I'm just kind of breezing through some of this data because I just kind of want to make a case for the strategy that we're doing that I think investors who've got money in their qualified accounts should do. This is from Mark Fleming. I thought this was kind of interesting. Two quotes, one from Mark Fleming, one from U.S. Bank. There's still more buyers than sellers. That means a meaningful price decline can't happen. There's just generally not enough supply. The U.S. Bank said, while the housing market is indeed cooling, this slowdown doesn't look like the most real estate downturns. Despite prices being high, the actual volume of home sales has plunged, and inventories of homes for sale have fallen sharply too. Homeowners who locked in 3% mortgage rates a couple of years ago are declined to sell, and who can blame them? With current rates more than double that, so the supply of homes for sale is even tighter. As a result, the correction will be nothing like the utter collapse of property prices during the Great Recession, with some housing markets experiencing a 50% creating of values. And the reason I wanted to mention this, you'll listen to some investors who are saying, hey, it's going to be bad. It's going to be just like 2009, 2010, and it's going to be very, very rough. Be careful and so forth. First of all, if that were to happen, that means there's going to be a great opportunity for investors to take advantage. I was talking to a realtor yesterday about one of their buyers that has 31 million in 1031 that they need to deploy, and they are looking for like land development deals. And I asked them, I said, how do they get their big start? And it was back in 2008, 2009. They went gangbusters and buying up foreclosures and made over 150 million out of that period of time. So if there were to be a recession like that, that would be a great opportunity to take advantage for investors. However, again, we don't see that. We're not forecasting that because, again, of statements like this and data points like this, where inventory is down because of different reasons, but the demand is still there. So I want to kind of bring that into why we're seeing different strains in investing. Maybe you've noticed strains with investment deals that you've done, and you're like, well, what you're saying isn't necessarily tracking with what I've experienced, and I'll explain that here in a minute. Is now a good time to invest in real estate? The answer is yes, but I want to point out a couple different mindsets between retail versus wholesale, or consumer versus desperate seller. A lot of investors, when they look at the real estate market, they're thinking more of a consumer position, meaning maybe they fixed a house, rehabbed a house, fixed it up, and now it's on the market and it's ready to sell or it's ready for the home buyer to come purchase it. It's for sale, and so maybe you're more familiar with that model because maybe out of your IRAs you have done private lending. And maybe you're seeing kind of some stress points on that. For us this year, this has been probably one of the most challenging things. And the reason is because of the shift, not in prices, but in a lot of restrictions and qualifications that a lot of these first-time home buyers are experiencing with their lenders. We've had more deals go under contract and fall through almost kind of in the ninth hour because of some changes that the buyer had seen come across from their lender. It has been a very challenging year for us from a cash conversion cycle, saying, hey, we're putting this cash out, it's going to be on the market for this long, and now we're going to expect this to sell at this time frame. And then it doesn't happen, and now you're scrambling, you're putting the house back on the market, you're maybe calling up private lenders saying, hey, the deal fell through, and so now there's going to be extensions and so forth. So maybe you've experienced that with a private lending deal that you've done, and you're like, man, I just don't necessarily know if it is a good time to invest. And then for some of you, maybe you haven't noticed that, but I say that to say that there's other opportunities to take advantage of what's currently happening in the real estate market that allows you a little bit more flexibility, that allows you a little bit more security in some ways. And one of the things that we've really focused on this year is providing different strategies to be successful in this current market. One of the things that we really are trying to emphasize is properties that are distressed, that you can't necessarily sell on the market because an FHA loan isn't going to be, they're not going to approve that. A lot of these homes aren't available for first-time investors. They're in poor shape, or for whatever reason, the seller's distressed and he needs to get out of it very, very quick. Maybe he's an investor and he's over leveraged himself and he's experiencing issues with selling some of his houses that are on the market. And so he's created kind of a log jam for himself. There's a lot of different things out there that are creating opportunities for investors like yourself to take advantage of. But it's a different mindset. It's buying the properties pre-rehab. So let me kind of hop into what we're seeing and what we're recommending. What strategies are currently working? Acquiring distressed properties, adding value through renovations, and then generating cash flow through renting. It's the most simple. It's something everybody's heard a million times. It's not like we just discovered this, but it's one thing that is working very, very well right now. I've had a lot of investors who've over the years have said, I would love to maybe buy my own house and rehab it and create, a great profit for us, or create a better equity play and create good cash flow for us. But, I'm an attorney, or I'm a doctor, or, I'm in a different sector that's got a great job. I don't need another job. And I really don't know how to go about that. A lot of people don't necessarily know how to find contractors or property managers or real estate agents or title companies, and they don't understand all the moving parts in the process of investing from a flipper or a person who's wanting to add value to distressed homes to get them to a place that creates a huge equity play for them. And a lot of people don't think of using their IRA qualified money for this strategy, but it's a great way to add incredible value to your qualified money, to your accounts, to create great wealth by adding or by buying properties that you can add value to. One of the things that some people kind of shun away from when they hear this because of UBIT is recycling those funds through financing and multiplying the value of the fund and increasing your ROI. A lot of investors are like, I don't want to have to deal with UBIT, and they overthink UBIT in a lot of ways. And so therefore they don't necessarily maximize opportunities that they have. And then being able to provide great cash flow is awesome for investments through your qualified accounts. If you can add equity and see a huge appreciation over a period of time, invest 100 and over 3-5 years, you get 130 or 150, or in some cases, multiplier on or multiples on your investment. That's great. But then if you include the cash flow on that, it's a great strategy that a lot of people just aren't utilizing. This is something everybody's heard. Every guru says it. It's not anything that is new, but cash flow is keen right now. Right now, money is really drying up. 2-3 years ago, investors were using HELOCs to invest, and they were doing a lot of private lending, and they were, deploying capital through HELOCs where they had rates at 3-4%. But once those rates jumped up to 8-9%, people weren't necessarily excited to use HELOCs. And what's happening is it's becoming harder and harder to find capital right now, which is a great opportunity for people that have cash, because now they have the ability to put that cash to work and then create cash flow that gives you the edge over a lot of investors. One of the things that we're seeing is deals coming across our desk where people are desperate because they don't have cash flow. They don't have enough liquidity. And so they're willing to let go at a great price that gives ourselves or our investors a great opportunity to take advantage. And so if you've got dry powder, now's the time to invest. We see the Feds didn't raise rates. There's projections and predictions that they're going to cut rates 3 times next year. maybe a quarter point each time, that's definitely going to help create a little bit of a spike and buzz in the consumer part of the real estate market, where first-time home buyers are going out there trying to acquire homes. But you're going to see that continue to grow if they drop rates, and you're going to see it kind of go gangbusters again. So now's the time to take advantage if you've got some dry powder. So cash flow is key. I just kind of want to show you some deals that we're finding or acquiring that investors like yourself could take advantage of. This is a property that we purchased in Ohio. We were able to lock it up at 94,000. The ARV is 165. Now we need to put in around 30,000 in rehab. The property is, for the most part, in really great shape, just a lot of cosmetic work. And then what we try to do is we maybe take out plastic shower inserts, and we put nice tiled insert or nice tile showers in place. And, we update the kitchen and try to add value to the kitchens and to the bathrooms, because those will increase the value. But then also, if you put good quality work in these homes, they last a lot longer, which limits your exposure to expenses and things that you've got to replace over a period of time if you're keeping these as rentals. So immediately after a rehab, we're creating a fairly good size equity play just right off the bat. And then this property here will rent for around $1,400-$1,500 a month. So after you take out your expenses with taxes and insurance and property management and your maintenance reserves, you're looking at around a 9% return, which again isn't necessarily the sexiest return. I think over the last couple of years, investors have gotten spoiled with double-digit returns, but a good consistent 8-9% is still a really great investment, especially, or a great return, especially in a market that is a lot tighter, where things aren't as I guess things aren't as booming as much. And so those returns start to dip and you start seeing things shift. If you can put capital in a tangible asset that creates equity, that creates appreciation, and it cash flows at 8-9%, that's a great investment opportunity. So this is just one house that we have acquired. Let me show you another one. This property, we purchased it for $68,000. We put $70,000 worth of work into this property. It's worth now $185,000, creating a very solid equity play. And then also we'll rent for around $1,400 a month. So there's deals out there like this that if you've got dry powder, you can take opportunity of. Here's another one. We purchased this Akron. It's not too far from the university, and it's perfect for student housing. $79,000 purchase. It's going to take around $45,000 to rehab the bones, and everything's really good. Just needs some decent cosmetic work. The value will be around $170,000. This is going to rent for more than your average rental. Again, just because of student housing, you can rent them out by the rooms, and just right out the bat, creating a fairly large size equity play, as well as great cash flow. Here's a group of properties that we purchased this year, and we did it through our fund. And I'm going to hop into our fund here in a little bit, just kind of showing you an opportunity of how you can invest in this type of strategy. We purchased this through our fund. These homes were, this is kind of a sweet deal. When people hear Gary, Indiana, if you're not really familiar with the market where it's currently at, I think people freak out. Oh, I would never invest in Gary. I was speaking at a conference back in November, and I mentioned that I just acquired some properties in Gary, and this lady about fell out of her seat in the front row. She gasped, really loud, and of course everybody laughed. I said, I understand, but let me share the deal points with you. And after I did, she immediately shouted out, "That's a great deal." My dad, he called me up. He's like, "I heard you're acquiring properties in Gary. You shouldn't do that, But Gary's actually making a turnaround because of investors. Investors are going in and they're buying these properties that have been vacant for a very, very long time and adding great value to them, making them great quality homes. and you're seeing a huge growth spurt in Gary. You're seeing families coming out of Illinois. Maybe they've got government vouchers, and there's just not enough demand, or there's not enough supply for the demand in Illinois. So you're seeing them come into Gary, and you're able to get really good quality tenants in and have really great cash flow. This set of properties here, we bought 29 homes from a friend of mine who is somewhat similar. It was in the business that I'm in, buying distressed properties and turning them into turnkey rentals. And he was tired of property management. He loved the cash flow, but he was tired of the property management. And so we did a deal where we acquired these for 2.2 million, but he did owner financing. So we only had to bring 15% down, and we did a 30-year note at 8% interest. And of course, everyone freaks out when they see 8 or 9% interest, but really that's not a big deal when you buy at the right price. We got these properties around a 70% market value, and they're already cash flowing. Some of these rehabs happened, 5, 6, 7 years ago. So they're a little bit older in their rehabs, but they're still great quality rental properties that don't need a whole lot of work, that are cash flowing. So we were able to do this deal where after the monthly payment, our investors, my lights just turned off. I'm sorry about that. I got them on a sensor there. After the monthly payment of $13,000, the cash flow was around $5,200 a month. And so over a 12-year span, we're providing our investors in our fund a 16% return. And that's before the equity. That's before any appreciation growth. That's just based off the cash flow. So what I'm seeing in this market is ways to create passive income through active investments. Being able to put your money to work for you without you having to do a whole lot for it, and it just continuing to grow. And with our fund that we've structured, the whole idea is to allow you, the investor, to partake in the returns that you would see if you were the one buying the house, rehabbing the house, and renting it out and selling it. One of the things that I've kind of been real leery of, and that I've tried to draw back from, is doing a lot of private lending. Because again, with the way the market is, it's really, really hard to really have a great estimate of timeframes. If you've got a house and in the time frame from acquisition to rehabbing to having it on the market fits, but then it falls through contract a couple of times, it's going to blow your projections and your timetables out of the water. And so for me, it's like, okay, what can we do to take advantage of what we're seeing, but give investors an opportunity to really be a part of that? Some things that we saw, like the bigger guys do. Blackstone, for example, they created a vulture fund where they loaded it up with cash from investors, and they had it ready to go to deploy to start soaking up deals as they started coming across their desk at a discounted price. They're buying them with cash, and they were allowing their time frames to happen. And if it went past their projections, they weren't seen as big of a hit because they put cash in versus leveraging. What we're wanting to do is create that same opportunity. Now, I don't have to be a shark. I don't have to have $1 billion vulture fund. I am totally okay being a sucker fish and following the model of the sharks and doing it at a much micro scale, but allowing investors who have funds ready to go to take advantage of those type of opportunities. So we're putting together, or we've already created, an equity fund that allows investors to put their capital in. And instead of interest payments and returns that maybe people are normally used to seeing, they're seeing cash dividends come in from rental income, almost like an apartment syndication deal, but in the single family sector. The Indiana properties are an example of that. And what we're seeing is we're seeing people who are desperate. We're seeing people that need to sell. There's creative opportunities and creative financing where you can, like the Gary deal, leverage your capital and be able to increase your value just right off the bat. because you only had to put a little bit down versus having to put the full payment down. You're seeing people who are willing to be creative and do things outside the box that allows investors to really take advantage and really build their investment portfolio in a time where a lot of people are scared, in a time where things seem very unstable. And now is the opportunity to do so. Our fund that we have is called the FF Asset Fund 1, and it's a $10 million fund. I'll just hit some of the highlights for you. It's a 3-year minimum. And basically what we're doing is we're allowing investors to come in and partake in buying these properties and being an owner of the properties, and then allowing that property to cash flow for them, but then also to see great growth. This is just kind of an example, and I'll breeze through it. This is definitely not a sales pitch. It is more of just kind of demonstrating what we're doing. And there's a lot of other groups out there that have similar things like this. Or if this is something that interests you, you're more than welcome to reach out to us, and we'd be glad to share more with you. But just for an example, again, this is one thing that a lot of people with qualified money shy away from because they have a misunderstanding of UBIT. But it's an opportunity to take advantage. This is a house example that we have. We bought the house for 80,000 or 90,000. We put 30,000 in rehab. The value is 165,000. It's going to cash flow at 9%. But then we could turn around and refinance it using the equity that we've created here as the down payment to pull out the 120,000 or a majority of that 120,000 out of the deal, and then reinvest it into a second property, and then repeat the cycle again. So it's that BRRRR method: buy, rehab, rent, refinance, and repeat. And so this is a great strategy to do. And again, it's a great strategy to do through an IRA, even if there is going to be UBIT. That's just the cost of doing business. But you have the ability to really grow your investment. So just out of an example, this one deal, 120,000 over a 3-year period, you're able to buy 3 properties. Your cash dividends is at a 31%, and the equity growth is 1.3%, just right off the bat. So again, just a really good strategy to take advantage of. Just a couple of different investment overviews. This is 2 funds that we did that we currently have that are equity funds. And the only difference is these funds bought full turnkey properties. They weren't buying them at a discounted price and doing the rehab. They were buying these at a full market value. And you'll see the annualized cash returns, very, very solid. The estimate or the IRRs through the equity growth, again, very, very solid deals. And I only share these to just show that the opportunity that you'll see in a fund like the one that I'm presenting, because now instead of buying them at a full market value price, you're buying them at a discounted price. I mean, we're buying houses anywhere between 40 and 60 cents on the dollar, and going in and putting another 10 to 20% into it through rehab and creating a 20% equity just right off the bat. And when you are able to do that, these multiples grow at a much, much quicker rate and provide a much solid return. How to be successful in real estate. I always like to just put this in, and it's more of a motivation type of talk than anything else. Dream big, always dream big. Where there's no vision, the people perish. And in years like this, where it's really sometimes a struggle and things don't always go your way, and it feels like you're striking out a lot, dream big. Don't lose your vision. Really, really try to master that and really try to grasp that. Second, plan, have a good quality plan, whether you're in the active investments or whether you're just doing it from a passive standpoint. Have a goal of what you're wanting to see, what type of returns you're wanting to get, who you want to work with, and then execute that plan. And then lastly, know your why. It's something I always say and when I speak, and it's something I always heard when I would go to conferences, and it would drive me nuts when people say, know your why. It's like, okay, dude, get some new material, because the guy who was on stage before you said the same thing. But it's such a powerful statement, and it's so true. Know why you're doing this. because in years like this, I'm sure I'm not the only one that has seen struggles and difficulties and plans not work exactly the way that I had them planned. Maybe you as an investor has seen losses and you've seen hits, and maybe it's frustrated you, and maybe you've questioned why you're doing this or putting the efforts in. Know your why, because it keeps you going. It keeps you wanting to overcome the failures, overcome the losses, and keep on going. And maybe your why is just building generational wealth, setting up a future for your kids or your grandkids. Maybe your why is you want to be more involved in ministry or charity, and you want to give back. Again, those things are what keep you going when things get tough. And it's just a great reminder to have. So I always just like to share that at the end. Maybe for some it's cheesy, maybe for some they just kind of roll their eyes, and I get that. And again, just because you have these things doesn't mean you're going to be successful. But if you don't have these things, you can pretty much guarantee that you won't be. And you have to learn, and you have to grow from the mistakes that you make and get better. And the way you do that is by planning and executing those plans. How you can invest with us, like I mentioned, the asset fund. We do have the debt fund for private lending, but again, I'm kind of getting away from that. I'm wanting to do more cash acquisitions and allowing investors to take advantage of the opportunities that we're seeing. So if that's something you're interested in and you love to talk, I would definitely love to hop on a call with you, and we can schedule it through info@freakyfast, or you can email me directly. It's just as simple. It's jason@freakyfasthomebuyers.com. And we love to talk with you. And you can, I think I have one more slide here, maybe not. Yeah, just shoot me an email and we can schedule a time to talk. I know right now the holidays are literally just a couple days away, and families are coming into town, or families are going out of town, and there's a lot of plans and a lot of things going on. But if you've got some capital that you're looking to deploy before the year's out, I'd love to chat with you. Maybe you've got some capital coming back and you're looking to deploy it in the first quarter of next year. I'd love to chat with you. Again, I hope this was helpful, just kind of sharing where the real estate market is, how you could take advantage of it through your qualified accounts. And Camaplan, thank you so much for just giving me the opportunity to speak, and thank you for being such great partners. And I'll stop the.
Jason, thank you so much for coming on. We really appreciate it. And if anyone has any questions, please ignore my poorly fixed green screen that fell off right before we started. But if anyone has any questions, feel free to put them either in the chat, or there is a Q&A function as a part of Zoom. Feel free to put them in there. But Jason, seriously, thank you so much for hopping on here. I know I learned a lot, and I'm sure that the registrants and the attendees did as well. So we greatly appreciate your time.
Absolutely. Thank you. I appreciate the opportunity. Merry Christmas, everybody.
Merry Christmas to you too. Not a question, but we did get someone saying thank you. But yeah, if you have any questions, feel free to put them in now. If not, we'll probably end it here. And like Jason said, you can always reach out to him with any questions. And if you have any questions specific to funding your IRAs, your 401ks, or getting involved with self-directed investing, you can feel free to reach out to us here at Camaplan. Specifically Will Mucker, whose information was at the beginning of this presentation. Yeah. But it doesn't look like we have any questions. But if we do get any, we will send them your way, Jason. But thank you so much for hopping on today.
Absolutely. Thank you, guys.
All right. Have a good one. And a Merry Christmas.